The UK budget is released in 3 days, and it could change how everyone in the UK saves and invests. Here's what we can expect and what I plan on doing. What's up, Effortless investors, and welcome back to the channel. If you're a beginner investor or someone saving steadily on a modest income, this video is for you. We're just 3 days away from the budget release on November 26th, and in today's video, I'm diving into what may be coming and how it could affect your investments. Now, I'm not a financial advisor, just a regular 9-to-5 guy building a realistic investing portfolio, one effortless contribution at a time. But that's enough rambling for today. Let's get into it. First up, why should you care? Well, the government under Chancellor Rachel Reeves is facing a fiscal shortfall of tens of billions of pounds, and economic growth is sluggish. As a consequence, the government may need to raise revenue and is reportedly looking at tax and ISA reforms. That's why even safe savers could see changes. Essentially meaning that this budget may not be just about small tweaks. It might include changes that impact how you save and invest, especially if you use ISAs, dividend stocks, or simply hold cash. So here are the rumoured changes that could move the needle. As I see it, there are 4 big changes being talked about. For each, I'll explain what's rumoured, which outlet reported it, and what it means for you as an investor or saver. Starting with the most reported rumour, which is the cash ISA allowance cut. Reports suggest the annual cash ISA allowance, which is currently £20,000, could be cut. This was originally rumoured back in February, and there were suggestions that the cash ISA allowance may be cut to as low as £4,000. Since then, we've had other reports suggest that it will possibly be cut to around £10,000, which is still a significant decrease from the current limit of £20,000. This has been reported by several outlets, including Reuters and The Telegraph. Since it was first reported, there has been widespread speculation across media outlets that the cash ISA allowance will be cut in the next budget. However, this report from Money Week suggests that even if the allowance was cut, 2/3 of cash ISA savers would not switch to a stocks and shares ISA. After some quick research, this may be because in one study, 67%, which is almost 2/3, of UK adults pay in less than £5,000 into their cash ISAs year on year. In spite of this study, if the cash ISA allowance is cut, savers who do prefer cash ISAs may have less tax-free space to park large deposits. This could push some to move into taxable savings accounts or into stocks and shares ISAs. There is also this report from The Guardian stating that a cut to the allowance could push up mortgage costs, with the report stating that the committee heard from building society bosses who warned reducing the cash ISA allowance would have negative effects on home buyers. They said building societies relied on savings deposits to fund mortgages, and the market would become less competitive without the inflows, potentially pushing up rates. Now, this is a difficult one to predict, so take this report for what it is, an opinion. So what can you do? If you're contributing modest amounts monthly, say £20 to £100, you're less exposed as you're likely way off hitting not just the current cash ISA limit, but also the cut that's being rumoured. So just continue your habit. If you were planning to deposit a large lump sum into a cash ISA this tax year, you may want to act before sooner rather than later if you can. You can also consider whether adding a small stocks and shares ISA portion may make sense for long-term growth rather than only cash. The next rumour I want to address is the tax on dividend income. Reports suggest there could be an intention to increase dividend tax or reduce the tax-free dividend allowance. This report from City AM suggests the Chancellor could increase dividend tax with the prospect of raising around £2 billion from it. Meanwhile, there are other reports that suggest the UK government is allegedly considering removing the current £500 tax-free dividend allowance. The Telegraph also suggested such changes are part of the government's plan to raise revenue and target investors. If you hold dividend-paying stocks or expect future income from dividends, higher tax may mean less net return. Ultimately, it may also affect how attractive dividend stocks are for new investors and current investors alike. With all that being said, this tax only applies to dividends received outside of a tax-advantaged account, like an ISA or a pension. So provided your dividend paying investments sit within one of these two accounts, you likely don't have to worry about this at all. Moving on to the next rumour, which is pension scheme and tax relief adjustments. One change flagged by Hargreaves and Lansdowne is that while the tax-free cash lump sum may remain safe for now, changes to salary sacrifice arrangements are now firmly in the sights of the Chancellor. It's a move that would spell bad news for employers and employees alike. Salary sacrifice arrangements are particularly valuable because by giving up a portion of their salary for pension contributions, employees get the value of every pound, saving both income tax and national insurance. Employers, meanwhile, save the national insurance that would have been payable on that slice of the salary. It means both will pay the price for any restrictions or salary sacrifice. Tinkering with the employer national insurance exemption on pension contributions heaps further pressure on employers at a time when many are already struggling with extra costs, such as the increase in minimum wage or last budget's rise of national insurance. There's every chance employers cut back on potential wage increases in a bid to save costs, and future increases to pension contributions could also be put on the back burner, given they would no longer come with the same national insurance saving. What this may mean is that for those with a long-term pension horizon, this might shift the relative benefit of pensions versus other tax-advantaged accounts. For now though, if you're contributing to a pension, just keep doing so. Don't stop because of rumours. If you're nearer retirement, look at your pension strategy now and consider seeking advice from a financial advisor. Make sure you watch for announcements about when changes take effect, as there is often a later date for implementation. Finally, we have broader tax rises. Several media outlets have suggested that the government is likely to pursue stealth tax rises, freezing of tax bands, raising business and property taxes, and cracking down on wealth extraction, through dividends, for example, which we've already discussed. This is speculated largely due to the fact that this government has previously promised to not raise the three main working taxes, meaning national insurance, income tax, and VAT. So in order to raise income through taxes, they'll need to look elsewhere. Capital gains tax could increase again, with an allowance for those investing in UK businesses. Inheritance tax could also see further measures, with a tightening on gifting rules. Property taxes could be in for an overhaul, with stamp duty rumoured to be replaced with a new levy on sale of properties worth over £500,000. Although some may argue that if your house is worth $500,000, you're probably doing okay. Even if your personal wrapper isn't changed, the broader effect on the economic environment may raise taxes, slow growth, raise inflation, and general market unease. That can affect your stock market returns, your interest on cash savings, and market sentiment. So in the wake of such changes, diversification may be more important than ever, making sure that your investments are not just relying on one asset class, and maintaining an emergency cash fund separate from your investments may become more important than before. With that being said, let's bring this closer to home. How these changes might affect you depending on your situation. If you're investing $20 to $50 or even £100 a month into a stocks and shares ISA, you're less exposed to these rumoured tax wrapper changes. Your biggest enemies are high fees and poor consistency. These rumoured changes are important, but they shouldn't derail your habit. So you should be able to keep contributing with confidence, or at least as much confidence as the stock market will allow for. Using low-cost index funds will still allow you to take advantage of a long-term investment horizon. If you value safety and you're on a modest income and you prefer savings accounts or cash ISAs, a cut in the cash ISA allowance may feel worrying. But note, a cut affects large lump sums more than small regular savings. As I stated earlier, some studies have shown that 67% of UK adults pay less than £5,000 into a cash ISA year on year. So if you're contributing gradually, you're somewhat insulated from these changes. Now, if you already hold dividend-paying stocks or rely on income from investments, or are close to or in retirement with pension income, these tax changes matter more. Higher dividend tax or reduced pension relief changes your net income. So ensure that you use tax efficient wrappers, like an ISA or a pension. Consider revisiting your asset mix. This is where tax planning really kicks in. So be sure to speak to a financial advisor if you're nervous about any changes that are made. Before we move on, it's important to remember that these are just rumours. There will absolutely be changes, but we don't know what they are or will be. So for now, there is no need to panic. So how does this possibly affect me? Well, I would say I likely fall into the beginner investor, or at least the low capital investor, low income cash saver bracket. If any of these changes were to be implemented, they are likely not to immediately or directly affect me and how I operate. I will still continue with my regular monthly contributions into my stocks and shares and cash ISAs, and my NS&I bonds as well, whilst also continuing my regular contributions into my child's ISA and pension. My current contributions don't even come close to the existing limits, nor do they come close to the rumoured reduced limits either. So from that perspective, I'm not concerned. I'm only likely to get affected if I receive a large cash lump sum, which, if I look at it glass half full, would be a welcome surprise. But for now, that's it. If you found this helpful, hit the like button and subscribe so you don't miss my follow-up once the budget is actually announced. Drop a comment below to let me know which rumour change, if any, concerns you the most. Thanks for watching, and remember, keep it simple, keep it realistic, and keep it effortless.